if you're 60 and you're getting a 30-year mortgage, you are not necessarily locked into that thing for 30 years. It's an option for, the mortgagee to keep that mortgage the exact same way for 30 years. But one of the things on their mind is, I don't want to have a mortgage when I'm 80 or 85, or, what if I just don't want a mortgage payment? That's where the reverse mortgage conversation comes in, just to let them know that as we work together in this working relationship as your financial advisor moving forward, this is one of the options that we would have on the table if you did want to cancel out the mortgage in the future. So this is a great presentation that was developed, just called Reverse Mortgages 101. Come over here and just click on through. Okay, so home equity can provide up to 50% of tax-free capital. You can use it to offset a shortfall of standard of living, so you can use it almost kind of like an annuity stream. You could use it to make improvements on your home if you want to age in place and you want to do some home modifications in case of long-term care events so that you can stay in your home. You could use it for that reason. Or really, I mean, you could just spend it however you want. Okay. Now, one of the most important aspects to a reverse mortgage to understand is that you still own the house. So this is still yours. As I mentioned, you have an increasing loan with the lender and no required payments. So again, you're getting money from the lender and the balance on your mortgage is going up over time. When you have any appreciation on the house, that is still yours. You still own, again, you own the house. So that appreciation is still yours. In some instances, you may have a line of credit associated with your reverse mortgage, your home equity conversion mortgage, which is the technical name for it. You'll get a line of credit in some of those instances, which will also increase as the house appreciates. And then when you get on all done and you're no longer in the house for whatever reason, due to care needs, disability, and/or death, you or your heirs, you can sell the house, pay off the loan, and you receive the difference. So again, just like you would sell a house with a normal, regular, traditional mortgage, you'll still receive those proceeds and be able to put them in your pocket. Nice thing about reverse mortgages is kind of the get out of jail free card. And this is what a lot of people are worried about is, if I take this reverse mortgage and property values plummet, and/or interest rates, just basically the interest rate I'm charged and paying on the loan here that I'm being charged, I'm not making payments, so that balance is going up over time. What happens if that balance is greater than my house value at the end of the day? Well, one of the great protections of a HECM, a home equity conversion mortgage, reverse mortgage, is that if you get to that point at the end of the day and the loan is greater than the house value, neither you nor your heirs are responsible. So you do have the option, or your kids, your heirs would have the option of, when it's all done, they go into the house, they take the personal items, personal property, the prized possessions, type of thing, take them out, put the keys on the kitchen counter, call up the mortgage company, say, okay, yeah, you can come get the house and do with it what you want. All right. So that is a protection, and this liability that will be just wiped out. That's one of the reasons the upfront costs on a HECM reverse mortgage is more than what you would pay for a traditional forward mortgage, because a good amount of those costs is you're buying, effectively think of it as like reverse mortgage insurance. Okay, you're buying insurance that if this happens, neither you nor your heirs are responsible for that difference. So that's a very important point. So going off of what we just talked about with getting your 30-year fixed mortgage on your new downsized condo for retirement, you get to 85, you just, I just don't want to have a mortgage payment at that point. What are my options? I want to feel like I have some more options. Well, if you have a mortgage loan balance, what you can do is you can use a reverse mortgage to just refinance the current balance. Again, I sound like a broken record, but you refinance your traditional mortgage with another forward traditional mortgage. You do the same thing, but now you're just refinancing with a reverse. The main advantage of that, why people like that, you have no more monthly payments. And again, depending on how much equity and just the qualifications, when you talk to the mortgage broker, you may have additional access to a line of credit within that reverse mortgage to do some of those other things we just talked about. You have 3 tax-free options to access your equity. And I do want to go ahead and highlight, underline the idea of tax-free. And why is that? Because the money is coming to you from the borrowed funds tank. It's happening after the tax filter. There is no tax filter that this money has to run through before it gets to you. So just like when you take a loan for anything, you're not paying taxes on those borrowed funds. So we do want to keep that in mind. You can just take it all out as a lump sum. That's option 1. You could use it as a monthly income stream, similar to, like, again, an annuity. So you could just have it come to you as regular monthly payments. Or you can use it as an equity line of credit to just draw on as you want, with the benefit of you can borrow money from the line of credit. And because it's done on a reverse chassis, you don't have monthly payments. You then have to make back to the lender. So those are the different options that we want to keep in mind, and just understanding how we can use reverse mortgages, again, in the context of right on the tail end of that Mortgage Master conversation.